So welcome to Forex Pros. Today we will be discussing the market of gold and seeing what kind of trading opportunities do we have in the upcoming week. We try to make this video as educational as possible so that you guys can learn a lot from it. And secondly, we will see that how easy is it to understand and analyze the market and spot the opportunities that we may found. But the difficult part is to stay disciplined. Without any further delay, let's move to the charts. Let me move myself into the corner so that you guys can see the charts clearly. So we'll start from the monthly time frame and see that the market has been on a bullish run for past 3 months. Before that, there was a pause for approximately 3 months. Now the market has continued its bullish run. Last monthly candle, before the closure of the candle, we saw that the market got a huge rejection. Two things to notice. Number one, the size of the wick is greater than the size of the body. Usually when this kind of candles is appears, it means that the next candle might try to cover the wick. So most probably we're expecting the monthly candle to go and cover the wick. It should be bullish. Moving down on the weekly time frame, what we can see is that usually what happens when the market creates an impulse, we wait for a correction. And to measure the correction, what do? We take the impulse from the bottom to the top, and what we can see is that the market is basically residing above the 0.382 level. So we can expect the market to gain some rejection from this point. Another reason why we are expecting the market to get a rejection from this point is that what we can see is that this last bullish candle, this was the low of the last bullish candle, and the market on the weekly time frame still has not been able to break below it, which means that the low is holding. So even if the market needs to break it, it should go up and then come down. So even on the weekly time frame, we're expecting some bullish move at the movement. Now we have done two time frames. Going to the third time frame, the daily time frame, which is very interesting and which spots the opportunity for this week. First of all, what we can see is that the market created the M pattern, and after the M pattern, we expect the market to go to the bottom neckline, and after that decide either it wants to go up or down, which means that while the market makes the move to the bottom neckline of the M pattern, we can capture that move. Now the thing is, where should we take the entry, where should the stop loss be, and this for that we need to move down on the 4-hour time frame. But before we do that, we need to understand one thing, that this is the resistance area of the market on the daily time frame. If we're talking on a larger scale, if we're talking very in simple terms, this move should be, the textbook move should be, market should break above it, retest, and then move to the upside. Now what a question should arise, like if the move is so simple and we can capture 2-3,000 pips so easily, why are people losing money? Because what we can see is that 1 2 3 4 5 6 7 8 9 10 for approximately 2 weeks the market has been stuck in this region. The market is not breaking either above or below it. So similarly, if the market does not want to make a retracement, it should go below this point. Now within this region you should not trade. That's a difficult part, because for 2 weeks people or retail traders, they usually don't wait because they want to make money every day. If we simply wait for the market to break above the structure resistance, and on the retest we can take the entry and we can capture 2 to 3,000 pips. But what happens is that the retailers, they try to trade within this range and lose everything. And when the opportunity comes, they don't have the capital or the confidence to take the whole move. Now coming down on the 4-hour time frame, we need to go even on the smaller time frames to get the proper stop loss. What we can see is that this is basically the support area of the market. And what we can see right now is market is basically residing above it. Why do we need to plot this area? So that when the market breaks above, goes for the retest, if we take the entry within this region, and after the break and retest, the stop loss should be around this point. Now it would be a 500 pip stop loss, but it's important to place a stop loss because market could make a fake move and come down again. In that case, your stop loss will hit. But again, if the market moves towards the upside, then you can capture 2 to 3,000 pips, which is a good deal, which is a good risk reward ratio. Now this is for swing trading. If you want to go for intraday trading and you want signals regarding that, you can join our Telegram channel, where we post educational analysis, where we post signals on daily basis, intraday trades, scalping trades, and people are making a lot of profits from it. So if you like the analysis, I try to make it as simple as possible. You don't need a lot of concepts. The only thing that you need is discipline. So subscribe to our channel, press the bell icon, and do tell us in the comment section which topic or video would you like us to cover in the next video. That's all for today.